So we're in what we call sort of a darkened theater format here, wherein you can see and hear us on the quote unquote stage, but you won't be able to really interact with the other participants of the webinar. So that means that your cameras are going to be off, you're going to be muted throughout. So you can kick back and relax. I don't know if you're back in the office like we are at CalPERS, or if you're still working from home. In any case, this should be a pleasant hour for you, so you don't have to worry about your on-screen persona. Just soak in the information. For questions that pop up, please go ahead and use the chat function of Zoom. So if you, depending on the device you're using, you can kind of scroll down to the bottom of the page or the screen. You should see a chat function as distinct from the Q&A function. It'll be easiest for us if you just type it in the chat. That way, everybody can see the questions. If you've got the question, I bet you that there's 3 or 4 other folks who are thinking the same thing. So if you type the question into the chat box, everybody can benefit from that. We reduce redundancy, and it'll just be a cleaner experience for everybody. So please go ahead and type your questions in there. The way we've sort of formatted this is I think it'll probably be best for us to push most of the questions towards the end of the session when we get into open Q&A, because many of the questions that might pop up will be sort of answered within the natural flow of our discussion. However, if you have a question that's ultra pertinent, I'll be looking for that and we can interject that as we go through. Our time for today for the webinar is allotted for 1 hour. So we're scheduled through 11 o'clock. We may not go that far. I've never had anybody to be outraged that the webinar ended a few minutes early. You get some of your morning back. But I assure you we will cover the content thoroughly and give you as much time as we need for questions at the end. Lastly, before we get into it here, the slides today will be made available to everybody. We'll make sure that those are accessible and shareable, and we'll get those sent out afterwards to everybody who registered. And we'll also post it to the CalPERS website. Okay. I think that hits it for most of our housekeeping. Let's go ahead and dive into the introductions and then the material. Next slide, please. So our presenters today are Michael Cohen, who is CalPERS Chief Financial Officer. And then we have Sterling Gunn, one of our managing investment directors over portfolio construction. And then there's me, your humble moderator, David Takearts. Here's our agenda for the day. First of all, we're going to define what we're talking about here when we use this term affiliate trust. What do we mean? What's the relationship to the main pension funding trust? How is that different from that? And then specifically, what are the main affiliate funds that are our focus here today? We'll discuss the broader asset liability management process. Those of you who contract with CalPERS for pension benefits have probably heard this term quite a lot over the last year. I know that that's just some of you. Some of you also contract with us just for the pre-funding trusts. And so this may be a little bit of a foreign term. So we'll ask Michael to carefully describe that and what goes into that. Then we'll talk about the capital market assumptions, which are the forward-looking best possible estimates of what returns will come in the different asset classes. We'll look at the candidate portfolios for the trusts. We'll then take a step back and look at those program benefits and then discuss what's coming up next in terms of the board looking at these, what could be adopted, and what can you expect over the next few months. All right, so that's the agenda for the day. Let me now go ahead and move ahead to the next slide, and I'll turn it over to Michael Cohen, our Chief Financial Officer, to take it from here. Go ahead, Michael.
All right, thanks, David, and good morning, everybody. Thanks for joining us. So in CalPERS parlance, we sort of use the term affiliate trusts, and you see all of them listed here. Today's webinar is really focused on the 2 in the box, which are our pre-funding trust funds, and I'll get into a little bit more detail about those in a minute. But the other affiliates are basically the non-main pension fund. So the acronym for that is the PERF that you'll hear a lot. But we also have, obviously a very large healthcare program that is funded out of our healthcare fund, the legislators program that's closed since term limits came into effect, the judges system, and our supplemental sort of 457 benefit program, as well as long-term care. So, but today, hopefully you are interested in our pre-funding trust, because if you are, you're in the right place. If not, we won't be offended if you move on and spend the rest of your morning doing something else. But why don't we go ahead and go to the next slide, and we'll get into a little bit more on these trust funds. I should say that these two trust funds do have a dedicated group of hardworking individuals at CalPERS, and I just wanted to take the opportunity to thank them for keeping the programs strong and healthy through the pandemic, continuing to provide excellent customer service. And we really do view these trust funds as a critical piece of the overall defined benefit pension program. That these trust funds are tools for you as employers to help you manage your long-term liabilities. So in that regard, we have two different trust funds. The first one has been around for about 15 years now. So it's considerably larger than our pension one, but the Retiree Benefit Trust Fund was established in 2007. It now has almost $18 billion of assets, and almost 600 different employers. And I'll give you a little snapshot of our employers in a moment. But really, this came out of the GASB focus on post-employment benefits, largely retiree health. And so, as I'm sure all of you know, they provide good opportunities to basically put money aside to pay down those long-term liabilities over time. Our newer trust fund is the Pension Pre-Funding Trust Fund. That's only about 3 years old now, and we established it in response to really urging and interest from our local government community. So for those of you who are involved in that, we certainly appreciate your faith in CalPERS, and we've gotten this program up and running in some pretty difficult conditions and are doing well so far. So you see, we've got 58 employers that are signed up for the program with about $72 million of assets at the end of the calendar year. So obviously a considerably smaller trust fund, but works in a similar way in that employers can contribute to the fund, invest the funds more aggressively than you would have it if you were just holding it in cash, and sort of use them to help pay your pension obligations whenever it's convenient for you as a local jurisdiction, whether it's because your revenues are running a little bit soft during a recession, or if or costs are going up, or it's just part of your overall long-term strategy to make additional payments as you can. And it gives you a good place to sort of, both of these trust funds give you a great place to sort of store your dollars to both lower your long-term liabilities and provide some more flexibility for you in terms of managing your long-term obligations and your long-term revenues. So with that, you might have noticed that I don't really tend to use the acronyms on these trust funds. I find when people pronounce them, they pronounce them in different ways and they all start sounding the same. So I prefer just a retiree health trust fund and a pension pre-funding trust fund as sort of almost as short as using an acronym. But why don't we go on to the next slide, David? So here you really see the combined 605 employers who are involved in one or both of these two pre-funding trust funds. So the state of California is one of our major contributors on the retiree health side. And then you've got a great mix of cities, counties, school employers, courts, and a lot of special districts and other agencies. And so thank you for to all of you for participating in these programs. Hopefully you found them as helpful as we intend them to be in managing your liabilities. So with that, let's get more into the meat of today's content and turn to the ALM process. David, if you can hit us on, there we go. So ALM is just our term in-house for asset liability management process. Just about any pension system is going to do some variation of this. And it's really sort of, for us, it's about making sure that everyone within the organization is talking to each other and all of the assumptions in the system are internally consistent and make sense. And so we do it every 4 years, basically kicking the tires to make sure the assumptions in our system make sense. We started this process, it's been over a year ago, and we really first focused on the main pension fund, the PERF, for CalPERS. And that was the process that, for those of you who've been following, really led to the reduction in the discount rate from 7 to 6.8%. And Sterling, in a moment, will get into the details on why the same trends are going to affect these trust funds. But really, from a CalPERS perspective, it's the investment office talking to the actuarial office. My office, the financial office, kind of plays a coordinator role. And then David's crew really takes the lead in making sure that all of our employers are getting what they need. We do report to our board of administration, provide them recommendations on what we think makes sense. And then ultimately, what came out of the PERF process in November was a new discount rate as well as a new asset allocation. That asset allocation really focused on putting more into private assets. And that's not something that, as Sterling will talk about, that's not really something that works for these individualized trust funds. But overall, the same process occurs for all of the affiliate funds. At the end of the webinar, I'll get into sort of the timeline and next steps, but we go through a very similar process for each of the trust funds to make sure all of the assumptions are responsible and internally consistent. And ultimately, the end result of that is really how we recommend allocating the assets in a particular fund. So with that, I think let me turn it over to Sterling from our investment office, and he can take it from here for a while.
All right, well, thank you, Michael. And thank you for really delivering all the hard messages. Because indeed, everything we're doing here is consistent with the way we've approached the PERF. And one of the messages we've been delivering for the last year or more is that the future is certainly not as rosy as the past was. And so this slide is just a way of sort of indicating that. So let me just walk you through the slide very quickly. The green bars have to do with what's happened between 1985 and 2021. And you'll notice we have US GDP growth, that's to the left, 4.8%, US Treasury yields, 4.9%, and the US equity total return, 12.5%. So those numbers are known numbers, that's history. So that's a good thing, we understand that. The blue bars are a projection. And one message we've been delivering for the last year and a half, there is a lot of uncertainty about the future. There always has been and there always will be. So although we have specific numbers here, the really important part of the message in this slide is not the projected numbers, although they are obviously low, but rather the projected numbers are lower than history. That's an important part of the message here. And we're going to see how that affects the portfolios, and in particular, the return and risk profile of the portfolios that we'll be discussing in a few minutes. But just so again, the projected numbers, a lot of uncertainty. We'd had exhibits with the PERF, we don't have them here, but that the range of projections is quite wide. So if you call your favorite bank, they'll give you a projection for 10 or 20-year returns, and there'll be a lot of variability. So the important part is understand that variability, but the overall trend is the same. The future returns are going to be lower than the past, and that in part is driven by the fact that the economic outcomes are going to be lower than the past. Having said all that, we had to pick some numbers, right? You have to have some hard numbers to calculate discount rates and so on. So when we go to this next slide, these are the numbers we chose. So if we can do that, thank you. And these numbers were taken from a survey. We'd surveyed a bunch of people, institutions that provide projections of future returns. And these numbers are basically the median outcomes of that survey. So, but you can see, global public equity, 5-year projected return, 6.8, 20, 6.8. That's a lot lower than maybe we've come to expect based on our past experience. If you look at US Treasuries, pretty low in the short term, a little bit better in the long run. And again, that's, there's a view right now that interest rates are low and eventually they're going to go up. It has to do with inflation and so on. So these are the specific numbers that we use based on that survey. What I will say though is we also did a lot of testing to understand the sensitivity of these choices. So that's a sort of part of our process. We don't want to anchor on just a point estimate or a single set of numbers, but understand if the numbers aren't exactly what we thought, what might happen. So with that, go to the next slide. Just a little bit then about some of the assumptions and so on. So most importantly, it's about balancing risk and return. That was the story we've shared with the board for a year and a half around the perf. And that's the same story that we have here. That's that consistency that Michael was talking about. In particular, I'd like to share a belief around risk and return. And one is that, again, return projections are very hard. It's a little easier to understand risk. And in particular, what we get to choose when we look at a portfolio, we choose an asset mix today. That is completely certain. The risks with that asset class choice, that asset mix, a little bit uncertain, the volatility and so on. The projected returns are even less certain. But nonetheless, it's about a balancing of risk and returns. And that's basically the same approach we've done with everything else in this ALM cycle. One change is we've changed the fixed income benchmark for the CERP. The long-term liability benchmarks have been re-optimized, and in part based on the previous CMAs, the capital market assumptions. It's a slightly riskier benchmark now, and the reason for that in part is having to take a little bit more risk in the belief that we'll harvest better returns in the long run. Another important distinction has to do with what's the projection period when we are constructing these portfolios. So in the case of the CERP, which is about long-term retirement benefits, it's really 20 years that we're working with. Now, in the past, it was 10 and 60. And what I can say, I think, is once you get past 20 years, if you talk to all the experts, year 20, year 25, year 30, they're all basically the same. So there's really not much difference between going from to 20 years or the 60s. So we focused on stuff in the 20 years. And again, that's because these retirement benefits are much longer term than are the prepayments. So you'll notice this difference. The prepayments we focused on a 10-year period, not a 20-year period. And then the last thing is asset class constraints. Again, we want to be consistent. So we use the same kind of constraints that we did when constructing the PERF portfolio. So we know that optimizers are tricky creatures. And so we have some sort of minimums of some of the asset classes just so we don't get outrageous looking portfolios. Go to the next slide, please. So I just want to explain here, for the CERP, there are actually 3 portfolios here, each with a different level of risk, and then an associated projected return. And so when you look at the slide here, I'll just walk through the components here. On the left-hand side, you will see 3 columns. And the first column is the current asset mix in this portfolio. This is of the 3 portfolios for the CERP, this is the highest risk portfolio. So that's the current asset mix. And I'll read it back to you, just so I'm sure we're all looking at the same thing. It says current. So you'll see 59% is in global public equities, 25% is in that long US liabilities fixed income benchmark I talked about. There's 5% in TIPS, 8% in global REITs, and 3% in commodities. Now, the other 2 asset mixes that are presented here, they're labeled A and B. And A is the recommended asset mix, whereas B is an alternative. People need to have choices. So there are the choices here, but the recommended one is the A portfolio. So that's what's on the left-hand side. Here on the right-hand side, you see this table, which has some of the important characteristics associated with these portfolios. So let's walk through those. So you can see a column labeled 2018 values. So this was the beliefs about the current portfolio that were held, I guess, 4 years ago now. So it had a volatility of 11.8% and a projected return of 7.6%. So that was the worldview 4 years ago. That same portfolio labeled current portfolio, we now see has a projected return that is quite a bit lower, 5.9%. We see a volatility of 12%. So it's a little bit riskier and the return is lower. We've also introduced a new risk measure we've called drawdown. And this is, if there's a loss in the portfolio, what does a really bad loss look like? And technically, this is over a 3-year period, what's the 10th percentile loss? So, if you were to make a histogram of the losses, this is the worst 10%, basically. So that would be 25.8% for the current portfolio. So then we also have the same kind of numbers for the candidate portfolio, the one that we are recommending, portfolio A, and the alternative portfolio, candidate B. So what do we see here? Well, again, similar risk, because again, risk is something we think we understand a little bit better than projected returns. So here's a volatility of 12.1, which compares with the current portfolio. Has a return that's about the same, and it has a drawdown that's about the same. So in this particular instance, it's not too dissimilar from the current portfolio. And that's really a little bit of luck, because we'll see with the other portfolios, that trend does not necessarily carry through, but all three outcomes are the same. So if this is the riskier of the three portfolios, we can go to the next portfolio. It's a little bit like Goldilocks here, maybe the three choices. So this is the medium portfolio. And I won't walk through all the details here. I'll just sort of highlight some of the differences. So again, tried to have similar volatility. So if you look at candidate A, volatility of 9.9 compared to the current portfolio having a volatility of 9.5. And you'll see a little bit of additional risk. There is a little bit of extra return projected in this portfolio. Candidate B, and my apologies, I didn't spend much time on the previous slide, but I will here then, is a riskier portfolio. Its volatility is 11.1% compared to the 9.9, and it gives a little bit more of a projected return, 5.8. But you can see you're taking over 1% more additional volatility risk, and you're taking about 3% more drawdown risk to get that extra 30 basis points. Given returns are highly uncertain, you'd have to ask yourself, how convinced am I that I will realize those 30 basis points? So this is the medium risk portfolio that's offered for the CERP. And then the third one is on the next page. And this, again, lower risk than the first two, but you will see here, compared to the current portfolio, this is a riskier portfolio. So the current portfolio has a volatility of 7.5% and a projected return of 4.5. And we're now showing a recommended portfolio has a slightly higher volatility of 8.4%, still less risk than the first two choices. It has a projected return of 5% and a modestly higher drawdown of 15.8 compared to 14.2. The alternative candidate portfolio does have higher volatility, higher drawdown, and again, a modestly higher projected return. So that is the three CERP portfolios. And then in a similar vein, and I should have mentioned, these are all based on the 20-year projections that I discussed earlier. So if we go to the next slide, we now get into the sector where we have two offerings, really sort of a modest risk and then a lower risk. And again, the same kind of story prevails here. If you look at the returns that were the assumptions used 3 years ago and make a comparison to current state, you see current portfolio, the returns are projected to be lower and the risk is projected to be slightly higher. So the recommended portfolio, again, has comparable risk of volatility, 8.8%, has a comparable projected return, 4.5%, and a slightly higher drawdown risk. And again, the alternative portfolio, slightly higher risk again, 9.4%, slightly higher drawdown risk, and a modestly higher projected return. So if that's sort of the moderate risk portfolio, if we go to the next page, for the SEP, this is the lower risk choice. And again, these are based on 10-year projections because again, the needs of these portfolios are more short-term than are the long-term retirement benefit portfolios. And again, we see here that the current portfolio has a lower return than was assumed or projected 3 years ago and slightly higher risk. What's important, again, the recommended portfolio has slightly higher volatility, slightly higher risk, and a slightly higher projected return compared to the current portfolio. The alternative portfolio is not recommended, but Again, higher risk still, higher drawdown, and a modestly increased projected return. So the overall theme for all the portfolios is compared to the views that were held 3 or 4 years ago. Portfolios today are going to be riskier and have lower projected returns for each unit of risk. So it's a matter of constructing asset mixes, which we are certain about, estimating the risk, which we have some stronger views on, and then a projected return associated with taking those risks. Right, so if we can go to the next slide. So this slide is just trying to illustrate the difference in outcome. So imagine you are contributing $50,000 a year for 20 years. And depending on your return assumption, the outcome will vary. So this illustrates the variability of outcomes. You know, it's not a particular portfolio so much as it is if you had invested $50,000 per year. And if you look at the table on, well, let me walk through this. So I'll start on the right-hand side. On the right-hand side, you see the sample returns, soon to be somewhere between 3.5% and 7.5%. And we're going to see that the value of the fund at 10 years and at 20 years, depending on the assumed return rate. Well, the graph is a little bit easier to look at, right? So that lowest line, the dark blue line, is the outcome if returns are 3.5%. And the top line, that amber colored or gold colored, depending on what you'd like to name it, is if returns were 7.5%. Not surprisingly, then that growth is higher. What's the net outcome? Well, if we go back to our table, at 10 years, we can see there's a difference in the value of these particular funds. So if 3 years ago I had assumed 6.5% returns, now I were to assume 5.5%, the outcome goes from $720,000 to $680,000 over 10 years, and just over 2 million down to 1.8 million over 20 years. That's the kind of difference in the outcome, just because the projected returns are different. So that's really the key message here. If you made it a return assumption, you can pick the number that was appropriate for you, and you can look at it and say, okay, in this stylized model, I have some idea of how the outcome will be different. Clearly, circumstances are bespoke to each of you, and so there will be some deeper nuances that will have to be dealt with, but this is the broad theme here. And I think with that, I think I hand it back to Michael.
All right, thanks, Sterling. And as we both mentioned, these are really trends that are happening throughout experts in the investment field. And so anyone you would be talking to about sort of long-term projections of what's expected to return should be giving you similar answers. And this slide here just kind of, for those of you who are already members of one or both of our pre-funding trusts, it should be information that you already know, but really the point is that our fees are kind of comprehensive in terms of covering administrative, custodial, and the investment fees. And we do always want to put a focus on keeping those fees as low as possible. And so you see on the retiree health side of things, our fees right now are 10 basis points. So on, basically 0.1% if you're looking at expected returns. And then our pre-funding pension trust fund is a little bit higher at 25 basis points. But as assets grow in that trust and we add in more employers going forward, we do expect the cost of that trust to come down as well. So it is something that we're constantly looking at, finding ways to make sure that you as employers are getting good value from CalPERS for being the conduit for investing your trust fund dollars. So why don't, David, we go to the next slide. And so this sort of starts us moving towards what comes next in terms of CalPERS internally, in terms of the decision-making process. So Sterling really walked you through our recommendations to the board. We'll be presenting those to our Board of Administration next week. So we have a board meeting Monday, Tuesday, Wednesday, and our investment committee will be meeting on Monday. And so as Sterling talked about, this fixed income benchmark, we do need to update that, and then also ask our board to adopt one of the two portfolios in each strategy that Sterling walked through. So we do, as he kind of walked through, we fully intend to continue to offer sort of a choice within each trust fund about how aggressive you want to invest the funds, and that'll really depend on your individual circumstances, how long you expect the funds to stay in the trust, as well as your own governing body's sort of tolerance for some volatility and risk going forward. But all of the discussion will take place on Monday at our investment committee, basically walking through the same information that's we just presented to you. And then just to wrap up with our final slide before we turn to questions, just in terms of the timeline. So as I mentioned, our board really focused 2021 on the PERF, our main trust fund. They've adopted that strategic asset allocation as well as a discount rate. And then we've sort of moved into the affiliate funds. And we're obviously now in March, where we're doing the webinar as we speak, and then coming back to the board for decisions on all of the affiliate funds. As I mentioned, we focused today on the pre-funding trust, but we are talking about all of those affiliate funds on Monday at the investment committee. And then once our board makes our decisions for us, Sterling and his crew in the investment office really take over in terms of having to make all of this work. And there is a lot of work in implementation of the various decisions. And so that'll happen over the next number of months in terms of the actual implementation of the board direction that we get next week. So with that, I think I'll turn it back to David, and he can facilitate whatever questions everyone who's participating has for us.
Great. Thank you, Michael. Appreciate that. Great job. And thank you to you, Sterling, as well. Thank you for that explanation. So we're ready now to take your questions. If you have any, please go ahead and type those into the chat box. As folks start to type those in, I'll just quickly point out the email address will be posted there. The CalPERS stakeholder relations email is the one that I and my team manage. This is sort of like the big catch-all email for CalPERS. If you don't know it, precisely the right person to send any questions, comments, or requests to, this would be a great one. It's our job to know who in CalPERS would be the right person to take those questions. So you can always send that to us. For these two specific affiliate trusts that we've been talking about here today, the OPEB trust. See, Michael, I do the same. I like get caught in like jargon and acronym soup here. So the pre-funding trust for retiree health benefits is the SERPT for you at CalPERS, and then we have the pre-funding pension trust at SEPT for you at CalPERS. So if you can jot those down, and that'll go right to the team that administers those, and they're the real experts on those specific things. Okay, so let's go ahead and take some questions here. I did see a couple of them come through. Okay, so I thought that this might be the question. So I'll read it out, and then just a quick comment here, and then I'll pitch it to, I think, probably Michael first. So if an organization fully funded the SERPT, okay, so folks, that's the OPEB trust, the Retiree Health Benefit Trust, and they're super funded at approximately 150%, is there a way to transition some of those funds to the SEPT, the Pension Pre-Funding Trust? Okay, that took a little bit of a different direction than I thought. So I'm not sure. Michael, you want to field that one?
Sure. And so one of these things with the trust funds is you really are, when you're putting money in, committing it to spend on the particular purpose of the trust. So while every jurisdiction's going to be a little bit different, and certainly you can consult with your counsel on these types of things, in general, know that once you put money into a trust fund, it needs to be spent on the purpose of that trust fund. So, but there probably are creative ways to start withdrawing funds if you're lucky enough to be in that situation, paying for your existing retiree health obligations and sort of pulling down your sort of super funded status and then making any new contributions into the pension pre-funding trust. So that is something that you're sort of restricted on what you can do, but I think you could get to the same endpoint with a little bit of creativity and a little bit of time and still meet the legal obligations that you committed to when you set up the trust.
Great, thank you. Two more questions. I'm going to lump them together and pitch them to Sterling. One question along the idea of addressing, do these options that we're bringing consider the volatility such as we see today, which is probably referring to the the roiling of the markets due to the Russia-Ukraine situation. And then another question kind of like digs into that a little bit more clearly. So the proposed portfolios all seem to significantly increase global REITs, real estate investment trusts. I can't help but think of real estate values in Ukraine right now. Seems like global REITs could be very risky depending on global developments that are unpredictable. So Sterling, your thoughts on that and how that is captured within our candidate portfolio suggestions.
Yep. So a couple of things. First of all, these are long-term portfolios. So I'll just start with that. So the short-term volatility, these things come, these things go. There's been different reasons for short-term volatility. So I think in the longer run, as long-term investors, we try to look through short-term volatility, try to make sure that we think we're harvesting the risk premium that we think are available in the market. On the specific thing around the Ukraine and the REITs, I don't have the details at my fingertips here. I can't imagine that this REIT index has a lot of Ukraine in it. It's going to be, I think, mostly developed markets. So if you think about real estate, again, yes, in isolation, it looks risky. And so do public equities, they look risky, or so do commodities. The idea is to build a diversified portfolio. The idea being, yes, we are taking risk, and we're hoping we can take different risks so that we are diversified. And in any given moment, one of those particular positions may look less attractive than the others, but it's actually really, really hard to second guess these things in advance when we're designing them. And the last part of the comment there is we do review these things. That's part of our ALM process. So we're mindful of that, and we do review our assumptions on a regular basis.
Great, thank you. This one's from Michael. So Michael, can you talk to us about the relationship between unfunded actuarial liabilities, the UAL, which is a chief concern for so many employers, and the pension pre-funding trust? Like, is that what it's designed to address? Your thoughts?
Sure. So it's certainly, the pre-funding trusts are designed to address the unfunded liability that you're always going to be making what's called the normal cost payment, just kind of the new annualized costs of providing pension benefits to your employees. And the unfunded piece is really why these kind of trust funds were developed. That being said, the accounting standards don't let you count what's in a trust fund to reduce your unfunded liability. So you could be in an incredibly good fiscal shape where you have an unfunded liability and have an equal amount in a trust fund, and you're still on your books going to show an unfunded liability. So the unfunded liability is really the amount actually in your pension fund compared to your overall liabilities. That if you have an unfunded liability, you're short in your overall pension fund, but that is irregardless of whether or not you have a similar amount of money in a pre-funding trust. So, rating agencies certainly recognize the value of these pre-funding trusts, and even if the accounting standards really don't. So it's something that you probably want to kind of highlight to your governing bodies and in your financial documents that you do have these, various funds available to cover an unfunded liability, even if it's not directly paying for that unfunded liability at the moment. I think the key is that in the trust fund, you have flexibility on which year you're going to use it to pay for pension costs. So while keeping it in the trust fund, you maintain the flexibility. Once you put it into the overall pension fund and perhaps eliminate the unfunded liability, at that point, you lose flexibility in terms of managing on a year-to-year basis. Hopefully that helps.
Yeah, Thank you. You're seeing probably, if you look at the chat, folks, there's kind of like some almost like dialogue going on now. So the original question was along the lines of, does CalPERS have financial consultants that could advise employers on the right amount to contribute to either of these trusts in order to manage their liabilities in these areas? And as several folks have chimed in, like the answer to that is really no. We have our actuaries that are working on on your the valuations for you, but in terms of managing, especially like these OPEB trusts, that's going to be one where, as Sterling mentioned, these are sort of like bespoke situations. There's different tolerances for each of the agencies, and really we would recommend that you work with your own consultants, whether that's an actuary. I saw several of them named here. I think that's the approach that's appropriate for employers there. So CalPERS doesn't have customized financial consulting related to how to manage these particular liabilities. Question now for Sterling. I'll just read it point blank and you can kind of address this how you want. So the question is, the total returns shown on the slides are gross return. What are the projected inflation rates?
That's a good question. And I should have mentioned, so was the previous question. These are actually the kind of fundamental questions we ask ourselves. So thank you. So the inflation rate here is 2.25. And I have to make clear though, like as I said, this is a long-term inflation rate. We're not trying to predict the inflation over the next year or 2 years. And that's why, again, we have this ALM regular review of these long-term assumptions, and we always want to test them. And if there's anything wrong about them, then we'll correct them over time. I know we've had this inflation blip recently, and there's a lot of questions. Is this a permanent kind of thing happening to us? Or is it just a transient thing and we'll get back to that long-term trend? And frankly, it's not really clear yet. I lean in one camp, some other people are in another camp. And what we'll do is we'll do our work and our due diligence over time, and we'll do the review, and we'll go from there. So.
Very good. Another question. So in terms of diversity, climate change has overriding impacts on funds. With perhaps oil on a decline, can we consider climate change driven investments for the long term? So maybe Sterling, like how that factors into our thinking.
Mm-hmm. I think overall, certainly with the PERF, it does through engagement. And I think that's an important thing to recognize, that I think most firms approach this from a bottom-up perspective. It's a very intensive process. There's not just a way of sort of magically allocating to a green world yet. That may happen over time. So at the moment, we pursue this through engagement. That's company by company by company. We probably really can't do that level of detail, I think, at the moment with the affiliates.
And let me just add that, CalPERS was a founding member of a group called Climate Action 100, which really focuses on the largest emitters in the economy and getting them on a path to net zero. And whereas our main pension trust fund is kind of where we've put our focus on climate change, there's going to be dramatic overlap with the same entities in these trust fund investments. And so the benefits of, I think, both having firms develop a path to net zero and our other area of focus is really on disclosure of risks. Both of those things will eventually kind of work their way into the pricing of the market and, in essence, get to the end goal of addressing climate risk, which we really do view as one of the major risks to the overall long-term future of pensions and investments more broadly.
Thanks, Michael. Another question here. So I know that for the pension pre-funding trust specifically, do we have any anecdotal idea of how cities are using these right now as reserves? The question is, specifically, do we have examples of city policies regarding the use of that fund? I know it's a new fund. It's kind of nascent here. What are you seeing?
Yeah, I mean, I think there in the chat there were some good suggestions that this is really where I'm looking forward to getting back to in-person conferences because this is the perfect spot for associations, whether it's CSMFO, GFOA, our employer forum in the fall, the League of California Cities, an opportunity to get together and just sort of chat with your colleagues in terms of what they're doing. And the chat here has been a great sort of substitute for that. So bottom line is we don't have a compiled list of samples. The various associations hopefully can help you out. I think on an anecdotal basis, we've seen sort of various approaches. One is just kind of contributing a fixed amount every year as sort of part of a budget process. And then other ones I've seen are more a share of sort of year-end reserve, so that if you end up with more than you were expecting, half goes into a trust fund or something like that. So there's really kind of two main approaches, but ultimately it's kind of figuring out, okay, how aggressive do you want to be? How quickly do you want to make contributions? And what trade-offs is your governing board willing to make in terms of, obviously, money put into one of these trust funds is a dollar that you can't spend on something else at a city service level. So hopefully that's a little bit helpful. And certainly our team can spend some time, if you want to shoot them an email, connecting you with other member agencies that might have a good model policy.
Hi, David. Can I chime in too?
Yes.
Hi, I'll introduce myself. I'm Fritzi Archuleta from the actuarial office. And just to add to Michael's answer, I had the privilege of going to CSMFO and speaking with a bunch of financial officers this year. And, one of the things that a lot of times our employers try to use is they see our projections, our 30-year projections, or even our short-term projections for the pension plan. And, because of investment losses over time, the rates are kind of trending up over the next few years. So a lot of agencies are also using these 115 trusts to kind of cut off that tip so that it's not as painful for them when it gets to the top of the contributions. I just wanted to add that. So.
Great. Thank you, Fritzi. All right, I am scanning through the chat right now, not seeing any further questions. So just want to remind everybody, we will make these slides available. We'll be sending those out probably by the end of this week. As Michael mentioned, this is coming to the CalPERS board next week on Monday to our investment committee. The materials for that have been publicly noticed on the website. So if you want to go check it out, you can look at it. It'll include the material that we covered today, as well as those other affiliate funds like the judges, the healthcare fund. So it's quite voluminous, but so we really wanted to get into like the core of the material here for you all today. And for those of you who are part of these two pre-funding trusts. So thank you very much to our speakers, Michael and James, or excuse me, Sterling. I appreciate that. And want to thank all of our employers for participating here. If you have any questions, go ahead and shoot an email to any of those those email addresses that you see on the page there. Thank you, everybody. Have a great day. So long.